All right, Commissioner, go ahead.
Thank you. My name is Rick Nelson. I'm the chair of the HOC Budget, Finance, and Audit Committee for our meeting on May 11th. I have joining us members of the committee, the chair of the commission, Roy Priest, and the vice chair of the commission, Fran Kelleher, our CEO, Stacy Spann, and other staff. So we will begin today's meeting. And for the beginning of the meeting, I will ask for a motion for approval of the minutes of the April 20th meeting of the Budget, Finance, and Audit Committee.
I move that we approve the minutes of April 20, 2021 for the Budget, Finance, and Audit Committee.
I second that motion.
All in favor?
Aye.
Aye. So it is approved unanimously. We will now go to the presentation of the fiscal year 2022 Opportunity Housing Fund. And for that, I will turn the meeting over to Cornelia Kent.
Good morning, and for the record, my name is Cornelia Kent. I am the CFO at HOC. On April 20th, Tomi Adebo presented the review of our FY22 recommended budget for the general fund and the public fund, and introduced some changes in the Housing Choice Voucher Program, which resulted in a shortfall of $14,000 based on reduced fees paid for the program to the general fund for overhead expenses. Today, we will review the FY22 recommended budget for opportunity housing, mortgage finance, and real estate development, and inform the committee of any changes before we present the budget for adoption. Terry Fowler, our budget office, will present today.
Good morning, commissioners and staff.
Good morning.
Morning.
If we could go to page 13 of the presentation, you will see that we began this budget at $292.2 million, and it was balanced with a projected draw of $1.5 million from the general fund operating reserve. On the next slide, as Cornelia mentioned, after our meeting reviewing the general fund and public fund, we are showing a shortfall of approximately $14.4 thousand based on reduced fees paid from the voucher program to the agency for overhead. We'll now begin opportunity housing on page 15 of the presentation. The recommended budget included income of $98.6 million in the Opportunity Housing Fund, the majority of which was rental income net of concessions and vacancies, coupled with income from our retail space, laundry and parking income, and various fees. Today, we are introducing changes reflected in light green, which are based on refinements that have been made to tenant income on a few properties, based on anticipated rents due to turnover, vacancies, and concessions, resulting in a reduction of $975,000, primarily due to higher vacancy than originally projected. The transfer between funds has decreased $149,000 due to a reduction in the anticipated shortfall resulting from lower bad debt projections that we will introduce on the next slide. Therefore, total income has been reduced by $1.1 million to a balance of $97.5 million. The chart on the next slide shows the distribution.
Cornelia, before you move to the next slide, this is a question on this one. On the tenant income reduction of $975,000, are you able to delineate how much of that is associated with COVID and how much of that is related to just rent payments?
The impact of COVID is typically reflected in our bad debt that we're going to discuss in the expenses. We do have some continuing high vacancy, but I do not have a distribution of if some of that is just typical vacancy or related to COVID.
Okay, thank you.
Well, and sort of a related question. At one point, aren't we gonna be presenting individual budgets to the Dev Corps?
At the June meeting, there will be packets that will be presented to the Dev Corp boards that will show the individual budgets of the Dev Corps, Diamond Square, and Brookside Glen Limited Partnerships.
Yeah, so Commissioner, at year end, some of the individual budgets you're seeing on a calendar year basis, and there winds up being a stub period, so the reconciliation is difficult. However, I think to both of you and Commissioner Priest's point, there has been, in general, over the last year, a drop off in leasing activity as a consequence of COVID. I think that Commissioner Priest is asking us to attribute a particular level of arrearage, bad debt, and then leasing inactivity to COVID. And so I think that's something we can take a look at and extrapolate across the portfolio for you all.
Well, I think related to that, and I assume it's included in what you've just said, since it's more than just COVID and it's a higher than normal or higher than anticipated vacancy, we need some, I mean, this is the committee that we have to have some discussion on vacancies, what they are, and or why they've occurred or what's being done to overcome them, and whether it's related to specific projects or is it across the board. I just don't know. But we need some sense of that to have a better appreciation for what comprises these figures.
Understood. Okay.
Okay. If we can move to page 16, this slide is showing you, as I mentioned before, that the majority of the income is the rental income. We do have other fees that we receive in the properties and a small grant, but the majority of it is the rents net of vacancy and concessions. On the next page, 17, this shows our 5-year history of the expenses in the property. Total expenses in the recommended budget were $96.3 million. When we prepared the recommended budget, we had projected bad debt numbers that we have since refined on several of the properties. And this is based on the experience that we've had over the last 6 months and the existing allowance balances in the property. So you will see that we are reducing the bad debt by $1.7 million. However, I would want to draw your attention to that this bad debt is still exceeding our historical bad debt prior to COVID by over $1 million. As a result of the reduction to revenue previously discussed and the netting that against the bad debt, we have a small increase in our operating reserve contributions for the foreclosure homes and an increase to the development corporation fee expense for those properties of approximately $606,000, as that reflects the cash flow from those properties. Therefore, our total expenses have reduced $1.1 million, bringing it to a total of $95.2 million. The next chart on page 18 shows the distribution of our expenses. And unlike the funds we have looked at previously, looking at our properties, there's almost an equal distribution between the operating expenses to run the properties and the non-operating expenses, which include the debt service on the properties, which you can see in orange is 3/4 of the non-operating expenses, as well as our contributions to reserves and the distribution of cash flow. Moving on to looking at our cash flow on page 19, you can see that our cash flow is distributed into 3 buckets. We have development corporation fees, which are the unrestricted cash flow taken as a fee to the agency on those properties. We have the unrestricted cash on the non-Dev Corp properties, and we have the cash that is restricted to the properties either through external or internal restrictions. We are anticipating an increase of approximately $552,000 in total projected cash flow for 22 when compared to 21, based on our most recent history of rental receipts. We have not yet reviewed the third quarter of FY21 in depth at this point, and it is very difficult with COVID to forecast the fluctuations in our cash flow based on that impact. Finally, moving on to the next page.
So Tara, just real quick to interrupt. So this is where she's, we start to intersperse the conversation and impact of COVID-related arrearage. And it's actually, let me try to disaggregate a little bit without being super precise. That arrearage would consist of non-payment of potential losses, and then, well, really those two components. So current arrearage that is owed but not paid, and then items that we anticipate, frankly, not ever collecting. And I'm sorry, Commissioner Priest, I think I cut you off.
Yeah, no, I was just observing in this chart that between 20 actual and the 21 amended and the 22 revised numbers, that there's been a fairly measurable difference in Development Corporation cash flow. And also the other area where restricted cash flow has also been significantly changed between 20 and 21 amended. Could you speak to that a little bit?
Yes, so on the Dev Corps, what you're seeing there is primarily the impact of COVID on our projected income from the properties due to the non-receipt of rents and somewhat to vacancy. On the restricted properties, one of the, our largest property is Cider Mill, and that is a restricted property. It has 861 units, but with the impact of COVID on the bad debt, their projected cash flow has gone to a negative balance in FY21 and flat in FY22. So you're seeing a very large reduction in income there. The other property that is contributing to that is our older scattered sites in our state rental program that are restricted and are now operating at a deficit due to the impacts of COVID.
Yeah, but I'm not asking for this now, but certainly it's going to be important to speak to what does the after COVID action look like in order to try to rebalance the performance on those particular properties.
So yeah, Commissioner, that's the big question, right? What does that look like? And quite frankly, it's going to be a difficult one to answer with precision. We have thoughts about it, but it's, this is what we feared going into COVID, that it would, for the folks who are most impacted, that is, have the fewest resources and lowest incomes, COVID has proven more expensive, more difficult, and will prove expensive and difficult to climb out of. And as a consequence, we're directly impacted there.
Yeah, I mean, I can imagine this is not unique to HOC and probably mirrors what's going on across the country, which from that vantage point helps to me. I mean, for me, is that that's a policy matter that we need to be looking at about how we should be perhaps going back to HUD as an agency administering a major portion of the dollars we get. And while there's been plenty of money for COVID relief, there may be some additional kind of consideration. It's called, post-COVID relief that we need to be talking about.
Yeah, I don't disagree. I will say though that current efforts right now, I mean, our current efforts are making sure that we're communicating with customers. We're continuing our efforts to maintain the eviction moratorium. As you all are aware, district judge recently ruled that it's unconstitutional, the nationwide eviction moratorium. So moratorium separate from rent collection. I mean, where folks can collect rent, we'd obviously like to, or pay rent, we'd like to collect rent. And so we're working hard to make sure that we avail ourselves of communication with customers, but also that we are actively engaged with federal, state, and local officials on rental assistance, so that whatever arrearage goes forward is as minimal as possible.
Yes. Thank you.
Question though, you just mentioned the district court decision in terms of eviction moratoria.
Yeah.
But local and/or state moratoria are not impacted by that decision. So the question, where are we? I'm sorry for not remembering. Where are we in terms of current, in effect, state and/or local moratorium?
Well, so look, a couple things. One, we at HOC, while we pay attention to it tangentially, you all, from the very beginning of this thing, established a no eviction moratorium before anybody else did. And so that's our North Star. I will tell you that I think that the state is encouraging folks to adhere to an eviction moratorium. They can't enforce it, except where they have paid out funds for a period of time to land. I mean, and even then, their enforcement is in question. From a local standpoint, they certainly don't have the ability to enforce it. And what I can tell you is that on the way to the office, I've seen a significant number of set-outs.
Set-outs, yeah.
I mean, look, the second the thing came down from the district court, I started seeing activity. So this is all about, forget what people are saying, forget the platitudes. This is all about ability to enforce. And practically speaking, even if it's in place, even a local one, unless you as a landlord have taken funds from that local entity or state entity, and there is a clause in there that prevents you from, you as landlord from evicting for that period for which you've taken funds, I don't see how they can force you to do it. And I don't think that I don't think that state and local officials are gonna have the stomach for that fight. I mean, unless and the issue here is, unless it continues to be a new definition for state of emergency, like so a health state of emergency or modified state of emergency for health or pandemic related reasons, I don't think it's ever going to hold up in the court. Now that you've had one judge a district judge crack the veil on it, there've been up to this point, particularly the end of last calendar year, hundreds of cases in state courts, right? And some of those were upheld, others were not. So I think it's about to cause pandemonium, is what I'm telling you. It's gonna, they're gonna be real issues. And so I think this county has to turn itself to getting that rental assistance out to landlords as quickly as possible, with the caveat that for that period of time, for the paid period of time, you've got to wipe the slate clean and give folks a shot. But we saw this activity building in the courts, the filings for some. We've seen it for some time. I mean, at least 6 months, at least.
One of the devastations of the view that you have seen, Stacy, of people being evicted, is not only people are in a situation where they have debt related to back rent that they cannot pay, but then they also potentially lose all their household possessions being set out on the street.
Yeah.
At the same time, they have no housing. And I know some years ago, this is deja vu, going through a similar situation. I was working in the city district. We actually, for our residents, actually had a large enough facility where we stored their furniture for a period, so they would avoid that part of the loss scenario. But I'm not suggesting that we do that. I'm just suggesting that we need to think about the total loss to the family, because they're losing their housing, they still got debt, they're losing their furnishing. I mean, and you know, it's a terrible position to be in.
Listen, I agree. I mean, look, it's not, if we were just business people looking at the bottom line, obviously, we might take a different view, but from a public service standpoint as well, this massive number of evictions is going to cause a level of strain on the social service supports that I don't think we've seen in a great many years. That's one. Two, remember, some of the reason that many landlords want to hurry up and evict folk is because the market pressure, the pent up demand, you're seeing housing pricing skyrocket, rental in some cases, but certainly for sale, right? And so folks are betting that they can raise the rents, and then in other instances, folks are wanting to get those customers who are paying the least rent out so that they can optimize potential rent.
Yeah.
And then there are a series of multifamily sales that are going to result from this stuff. It's unfortunate, and you're right. The cost to us as well as the customer is significant. And we've started talking about the financial costs around their belongings and instability. But
And their credit rating changes. That's the long-term problem.
Well, that's even a short-term problem, right? Because the way that credit is used
for employment.
It's exactly. It's not just about somebody's domicile. People aren't going to be able to get jobs at like the Gap, retail. And so I don't know. I mean,
well, now you know why we insisted first and before everyone else on the policy we did.
No, I knew it then.
Not evicting people.
I knew it then, and I agreed. And I still agree. But again, I think the onus is on local governments and administrators, state administrators of these rental assistance funds to get them out the door to landlords and nullify the eviction action. And it's just not happening. They're coming up with all these nonsensical screens about area median income, and a person who was at 80% or 50% at time of move-in, but now has compromised income, they're equally precarious in their housing situation. So,
well, I think, Stacy, that they're trying. I think these kinds of communications are difficult in terms of the channels, because it's not a normal channel to have to be communicating through. I know when I have been listening to various members of the state delegation discuss what happened this legislative session, they are mentioning the availability of these funds for people and encouraging everyone to look at them. I've also seen where at the federal level, I believe they are going to allow funds to go directly to renters if the lessor refuses to participate in the program, thereby letting the actual renter receive the funds to pay their rents and protect their belongings, credit ratings, and abode. So I think there's some movement to help with these situations, but as usual, democracy is slow, and it's probably operating at 1/4 to 1/10 the rate of speed that most people need it to operate at. But we'll have to watch and see whether catch-up works or not.
If some of the bureaucrats would change places with the people who are being impacted, maybe they'll act a little more expediently.
Yes, yes, I'm sure.
Question I have, Stacy and Roy, really, is whether or not there's any value in us at our next commission meeting having a more robust discussion on this whole subject. Part of the reason I say that is, and I go back to my question about eviction moratorium, I thought the county, along with other counties in the state, asked the governor to extend what exists now, which is a moratorium until June 30.
They have.
Though that has some limitations because it doesn't, as I understand it, affect holdovers. And I guess part of what I'm saying is that, as you alluded to, there are a lot of moving pieces in this whole thing. You've got the state moratorium, you got whether or not locals, whether it's federally funded. We have a significant impact, obviously, on our budget, all of which needs to be understood in terms of what's the impact of this, but also if in fact there is an issue in terms of not having access to the funds that should be accessible, whether to us and or to the tenants, it's something we need to put on the table and maybe discuss. So I guess what I'm looking for is maybe us to consider a more structured discussion on this topic and its impact on us and our operation.
I think, first off, yes, I think we can accommodate it, should accommodate it, at the top, as we wind down our community forum portion of the meeting. But Chair Priest, it's certainly your prerogative.
Yeah, no, I thought that's clearly a subject for the directors exchange, commissioners exchange. Have that kind of conversation. That's an appropriate place to do that.
Okay.
Yeah, and just again, Commissioner Nelson, yes, there has been a request to the state. Again, enforceability is the issue because there is no state of emergency. And what I'm saying is that we as a country
I see. Yeah,
have
okay.
to consider what state of emergency means, and we need to modify potentially the definition because what we can all agree is that while there may not be a pandemic state of emergency because of the surge of new cases and infection, there's certainly a related state of housing and I guess precariousness emergency, right? That's a fact. We're seeing, that and that ought to be just an independent thing where we're starting to look at as a state or as a county the number of filings year over year or period of time over years average. So anyway, just
that's great for the next crisis. I think we need to figure out how we deal with this one.
Yeah.
I agree.
On the point that Roy made in terms of, and you, I guess, also in terms of the setouts, I'm fuzzy on this one, but I thought there was some legislation a number of years ago that tried to reduce the impact of setouts by giving more notice to the tenants and more opportunity for them to get their things before they got set out, to try to reduce all this. And I just don't recall the details of that, but I mean, it's clearly a major issue. And I agree with you, Stacy, that I've seen more recently stuff set out. Just thought about that yesterday as I was going somewhere. Anyway.
What did pass was legal counsel for tenants at it when they are being taken to court for rent in arrears. So that may help in some regard.
Okay. All right. Sorry to, but let's move on.
Okay, if we can look at the slide on page 20, this represents the revised operating budget as it now stands. The changes in peach are the changes that we've introduced today, and there is one change in blue. As a reminder, we began with a $1.5 million contribution from the general fund operating reserve. The net impact of the changes to income and expenses in the Opportunity Housing Fund resulted in an increase of approximately $4,000 in unrestricted cash flow and an additional $606,000 in development corporation fee income to the general fund. As a result, staff is recommending that $500,000 of the additional income from the properties be added to the budgeted contribution to the Opportunity Housing Property Reserve to assist those properties that will not have sufficient reserves to support their capital budgets. Finally, in blue, the recommended budget included security costs at the existing Holly Hall site of $177,000. That site has since been fenced in and the expense will not continue in FY22, so we have removed that cost. The net impact of the changes we've introduced results in a positive balance of $273,000, which will be discussed at the end of today's meeting. If there are any questions on this presentation, I'd be happy to address them. Otherwise, I will move forward with the discussion of mortgage finance and real estate development.
Jerry, this is a very small thing. It says fund summary fiscal year 2022 revised as of 5/11/2021. Are we talking about the fiscal year 22 budget or this fiscal year 21 budget?
This is the fiscal year 22 budget that we are working through. And this chart reflects all the changes that have occurred to that budget since we presented the balanced recommended budget in April.
Okay. All right. When I saw that, I got a little confused because I know we're still in fiscal year 21 right now.
Yes, it's just as of today's meeting with the changes we have discussed thus far.
Yeah. Okay. Thank you.
You're welcome. Are there any other questions before we move forward? Okay. If not, we can move forward to mortgage finance and real estate on page 26 of the packet. Again, these are just showing where we began, and page 27 shows the adjustments we've made. And moving on to page 28 of the packet, this is the summary of the mortgage finance division and the 5-year history. The division generates loan management and commitment fees on the deals that are financed or refinanced by HOC and monitored for loan compliance. The commitment fees or financing fees are split 40% unrestricted to the agency to support operations and 60% restricted to the OHRF to be used in future development deals. These fees are one-time in nature, but do serve to supplement the rental income we receive for the agency. If you move on to the next page, you can see the distribution of the fees. The commitment fees in total account for about 46% of the income from the division. There are bond draws that pay for the administrative costs, and the loan management fees account for approximately 19.5% of the income. The next slide shows the distribution of the expenses, and the division, the majority of the cost is made up from the personnel that support the division. There's an additional 23% are the management fees that are paid to the agency, and the other income, including our FHA risk sharing. The next slide in our presentation shows the 5-year history of the real estate development group. This group generates development fees on the development deals, and similar to the commitment fees, that income is split 40% being unrestricted to support agency operations and 60% restricted to the OHRF for those fees. And this income again supplements the unrestricted cash on our properties. At this time, we do not have any changes to either the mortgage finance or real estate development budgets. Therefore, at this time, we still maintain the surplus that we discussed a moment ago of $273,000, keeping in mind that our budget has a draw of $1.5 million. We would reduce the anticipated draw from the general fund operating reserve by any additional income, which is now $273,000. We will do small refinements between now and June 9th when the budget is brought forth for your adoption, which will include an update of our complement and our allocated costs to the properties. So there may be small changes between now and June, but these are the changes that we have encountered thus far. And I'd be happy to address any questions you may have concerning our budget.
Fran or Roy, do you have anything?
I don't.
No.
So in terms of the budget process, Terry and Cornelia, this is it until June 9th?
Yes.
I mean, this is the formal process. Naturally, if there are questions,
Right.
or issues or even concerns over modifications we have made or have failed to make, and then finally, I'll just add a bright line clarifications. Then we want to address all.
Okay. All right. Well, thank you. And I think that we will, to the extent that we have any that come up over the course of the next couple of weeks, we will be communicating with staff on an individual basis what some of those questions might be.
Thank you.
That being it, I thank you. And I guess that concludes the business for today's meeting.
Yes.
It's been nice dealing with you folks. See you in June. Well, I'll see some of you later, but see you in June for the final budget presentation.